In this video, I want to share with you some of the top ETFs that offer some of the highest monthly dividends, as much as 11+%. And these actually pay you monthly. Whether you're looking to supplement your income or build wealth over time, the dividend paying ETFs I'm going to share in this video are definitely worth considering. If you landed on this video and you don't quite understand what dividends are, I do have a beginner's video explaining dividends on my channel, so please hit that subscribe button to watch it. Before I get into the list, let's quickly explore some of the benefits of a monthly dividend ETF. You know what's better than getting a quarterly paycheck? Getting a monthly one, of course. And that's just one of the many benefits of owning a monthly dividend ETF. Most dividend paying stocks and ETFs pay on a quarterly schedule. With monthly payouts, you can budget like a pro and have a steady stream of passive income flowing in. And let's be real, who doesn't love consistent cash flow? Plus, you'll be able to forecast your finances better than a weatherman can predict rain. And by reinvesting your monthly dividends more frequently, you can compound your interest, which means bigger returns for you in the long run. Let's also not forget about diversification. These ETFs are like the Tinder of investments, matching you with the best securities from all over the world. Even if you stick with a domestic monthly dividend ETF, you'll still have access to a range of sectors to keep your portfolio spicy. Last but not least, investing in a monthly dividend ETF is a smart move if you're thinking about the future. You'll have a recurring income source that can help you manage your family, create cash flow, and eventually retire in style. So, investors owning monthly dividend ETFs can enjoy certain benefits that may provide an advantage over owning quarterly paying dividends. But investing in ETFs can be as tricky as in navigating a minefield sometimes. One wrong step and your investment dreams go up in smoke. But fear not, my fellow investors. There are several key factors to consider before taking the plunge. First up, net assets. The bigger, the better. High asset ETFs are like the popular kids in school. Everyone wants to hang out with them, and they usually end up being successful in the long run. Next, trading volume. It's like the heartbeat of the ETF. If it's weak and feeble, it might not survive the market twists and turns. But if it's strong and steady, it can weather any storm and bring in some sweet profits. Of course, you can't forget about the underlying index. It's like the foundation of the ETF. You want it to be sturdy and reliable so you can build your investment dreams on top of it. Now let's talk about expenses. Nobody likes to waste money, especially when it comes to investments. Keep those expense ratios low, my friends. Last but not least, choose your broker wisely. You wouldn't trust your grandma's secret recipe with just anyone, would you? So make sure you pick a regulated broker with a good track record to manage your investments. In short, invest wisely, stick to your plan, and don't forget to do your research. And if all else fails, consult with a financial professional. Okay, I'm going to stop wasting time here. Let's get started. For the first ETF on my list, I'm going to start with the Global X NASDAQ 100 Covered Call ETF. This one goes by the ticker symbol QYLD. QYLD is a passive exchange traded fund, or ETF, that aims to provide investors with both income and exposure to the NASDAQ 100 index. The NASDAQ 100 index is a market capitalization weighted index of the 100 largest and most actively traded U.S. companies listed on the NASDAQ stock exchange. These are primarily tech stocks. So what the QYLD ETF does is to invest in the underlying NASDAQ 100 index and sells call options on the index. This strategy is called a covered call strategy and aims to generate income through the sale of options, while also providing exposure to the NASDAQ 100 index. If you're not sure what stock options are, I will be getting into that in a future video. What are some of the top stocks in this ETF? Its three largest holdings are Apple, Microsoft, Amazon, followed by Facebook, Alphabet, aka Google, and Tesla. If you're thinking about investing in this fund, it's important to note that covered call strategies inherently forfeit upside in exchange for current income. Therefore, covered call strategies can be used strategically in income-focused portfolios or tactically for investors who believe the markets are unlikely to continue to rise. The QYLD fund's expense ratio currently sits at 0.60% annually. That's a bit on the high side, but I've seen much higher as well. The 0.60 expense ratio basically means if you invested $10,000 in the ETF, your annual expense would be $60. Now, to wrap up my thoughts on QYLD, I'm going to be honest. As of the time of this video, this ETF has had a rough year or two, as have many other stocks and index funds, given the craziness in this country over the past couple of years. The pandemic, Russia, inflation. But as the old saying goes, buy low and sell high, right? So I personally think this fund is going to continue to rebound in the second half of 2023, and you can collect an insanely high monthly dividend from this ETF while you're waiting. So if you think tech stocks are due for a rebound, I think this fund could be a good choice if you're looking to create income. Same case if you believe the underlying index QQQ will remain on the flat side. If you are primarily looking for growth and not income, then I'd opt for the QQQ index instead. Lastly, if you think the tech sector is going to continue to crash through the rest of 2023, it's probably best to wait on this ETF and go with some of the other options I'll get to next. And this is probably needless to say for most of you, but just don't put all your hard-earned money in just one fund, unless it's maybe VOO. And also don't do it all at once. I'm a fan of diversification, and I also recommend dollar cost averaging. But what is dollar cost averaging? I'm so glad you asked. Dollar cost averaging is a strategy that involves investing a fixed amount of money regularly into a particular stock or a basket of stocks over a period of time rather than investing a lump sum all at once. Here's why it's important. By investing regularly, you take advantage of market volatility. When the stock price is low, more shares are purchased, and when the stock price is high, fewer shares are purchased. This helps average out the cost of the shares over time, hence the name dollar cost averaging. For example, let's say you want to invest $1,000 into company X's stock. Instead of buying the shares all at once, you'd opt for dollar cost averaging and invest $100 every month for 10 months. If the stock price is high when you start investing, your first few purchases might buy fewer shares. But as the stock price drops, you'll be able to buy more shares with the same amount of money. Over time, this can lead to a lower cost per share and potentially better returns. It's worth noting that dollar cost averaging doesn't guarantee profits, but it can help to take some of the emotions and guesswork out of investing and may help to maximize returns in the long run. Next, we have one of my favorite high yield ETFs that pay you each and every month. It's the JP Morgan Equity Premium Income ETF, which goes by the ticker symbol JEPI or JEPI. This ETF seeks to provide high current income and long-term capital appreciation. As of the time of this video, JEPI currently yields a hefty 11.69% and has an expense ratio of just 0.35%. The JEPI ETF invests in a diversified portfolio of U.S. stocks and non-U.S. stocks selected based on their potential for providing high and sustainable dividend income. This ETF may also invest in derivative instruments to help increase income and manage risk. Let me quickly explain what these are in a simple way. Really quick, then I'll get to the next ETF. Think of derivatives as a side bet on the future price of an underlying asset. The underlying asset could be anything from a stock, commodity, currency, or even an index fund. The value of a derivative contract changes as the price of the underlying asset changes. So, for example, if you have a stock and you're worried about its price going down, you can use a derivative instrument like an option to hedge against the risk. Options are one category of derivatives and give the holder the right, but not the obligation to buy or sell the underlying asset. Another example is futures, which is a contract between two parties to buy or sell an asset at a specific price on a future date. This is often used by traders to speculate on the future price movements of the underlying asset. The cool thing about derivatives is that they allow you to take advantage of market movements without actually owning the underlying asset. However, they can be complex and carry a significant amount of risk, so it is important to understand what you are getting into before investing in derivatives. Let an ETF such as JEPI do it for you. While I personally have invested in both QYLD and JEPI, in my opinion and from my personal experience, JEPI comes with less volatility than QYLD and has been a far better performer. But as mentioned previously, I do expect QYLD to slowly start to rebound in 2023 and into 2024. Because I typically invest for the long term horizon at this point, I'm fine collecting the dividend while I wait. And of course, I could always be wrong. Now let's get to the third high yield ETF on my list, and that's RYLD. RYLD is another high yield ETF by Global X that pays monthly. This one's a Russell 2000 covered call ETF and currently yields a whopping 13.4%. Unfortunately, its expense ratio is fairly high at 0.70%, as opposed to the QYLD ETF that buys covered call strategies against stocks in the NASDAQ 100. RYLD follows a covered call or buy right strategy in which the fund buys the stocks in the Russell 2000 index and then writes or sells corresponding call options on the Russell 2000 index. The Russell 2000 is an index of 2,000 small cap stocks listed on the stock exchanges in the United States, and this index is considered to be a good indicator of the performance of small companies in the country. The top holding in the RYLD ETF is actually the Vanguard Russell 2000 ETF at almost 29% of net assets, but it also holds hundreds of small cap stocks such as Yelp, Cracker Barrel, Elf Beauty, Foot Locker, and Crocs, to name a few. So, if you think small cap stocks are going to remain flat or outperform the overall market in the months and years ahead, and you want to collect a hefty dividend, RYLD is another ETF to consider. Just keep in mind that if you are looking for long-term growth and not necessarily income in the form of a huge yield, investing in the Vanguard Russell 2000 Index Fund, VTWO, would be the better bet. Its expense ratio is just 0.10%, and it still keeps some yield at 1.48%. In an effort not to have this video stretch on too long and begin to bore you, I'm going to wrap up these last few high yield ETFs rather quickly. So hold on just a couple more minutes because one of them may be right for you. Next, we have the Schwab US Dividend Equity ETF, which trades under the ticker symbol SCHD. This fund's goal is to track the total return of the Dow Jones US Dividend 100 Index. This index is designed to measure the performance of high dividend yielding stocks in the US with a record of consistently paying dividends and good fundamentals. With SCHD, you get the combination of a decent dividend yield, which is currently 3.61%, but also has a great track record of growth since its inception. It also has a very low expense ratio at just 0.06%. Unfortunately, this one does pay you quarterly, but it's definitely still worth taking a good look at. Lastly, you should take a look at the Invesco S&P 500 High Dividend Low Volatility ETF, which does pay you monthly and trades under the ticker symbol SPHD. As the name suggests, this one looks for stocks in the S&P 500 with high dividends and low volatility. It yields 4.06%, and like SCHD, this ETF has a history of nice growth and a fairly low expense ratio of 0.30%. I'm going to wrap this up. Thank you so much for watching this video, and if you found it at all helpful, please hit the like button and subscribe. I'd love to hear about your favorite dividend ETF, so please let me know in the comments below. All the best.